My dream desk finally came in. It's the Ergo.
A week day in the markets, and one of the most notable stocks is scheduled to report earnings tomorrow. We're talking, of course, about Tesla today on Open Interest. Hello, everybody, and welcome. Welcome to Open Mic. I'm Mike Coe, and we are going to be talking about Tesla today. One quick point of note is that this one's going to be relatively brief because I will also be discussing Tesla on Fast Money on CNBC, and that show goes live around 5 p.m. Eastern Time. I'm probably not going to be there right as that show begins, but probably for the B block or so. So we'll probably wrap this up around 5 or just a little afterwards. Okay, so as I was just pointing out, Tesla is due to report earnings. We're just going to take a quick peek here at what Unusual Whales has for us in terms of the expected move, and then we're going to talk a little bit about some of the notable price targets that have been assigned to the stock, whether or not we think they're believable and where those things are coming from, and what I happen to think about it. So for the first thing you're going to notice if we go over here is that the expected move, which is right now, according to this, about 9.3%. This must be the one-day reported move, because when I was taking a look at this just before the close, the April 25th weekly straddle, I believe I was looking at the 225s with the stock trading about 225.5, was about $24.5. So closer to 11% of the current stock price. That's essentially what the options market is expecting that Tesla could do, higher or lower on average by the end of the week. The straddle is typically going to correspond to approximately, statistically, the mean absolute deviation. How much the stock price could potentially deviate from where it's trading right now. If we take a look at this chart up here, we can see how the solid line represents the price path that Tesla shares have followed over the course of the last 21 days, and we can compare that to the dotted line. The dotted line represents the average move over the prior 7 reported quarters. And as we can see, actually, the stock has not tracked all that well going into the earnings print. It's slightly below that trend right now. I think there's a lot of good reasons for that. So let's just take, and we'll get a sense of it if you take a look at this lower right-hand chart right here. This histogram is basically just showing on an annual basis what's been going on with respect to revenues and earnings. And we can see here that, yes, revenues have climbed through 2024, but the forecast now is that we're not going to see any growth, and I have a feeling that maybe even that might be a little bit ambitious for the full year, and also that earnings are beginning to trail off. A lot of reasons for that. Some of those not the fault of the company. Some arguably are the fault of the company. So maybe we can just take a closer look over here. So I also wanted to point out that in the description for this video, I included 2 documents. Those 2 documents, I'm going to try to pull them up here. We're going to share them together, and then we're going to talk a little bit about them. One of those is the ARK Investments Big Ideas for 2025 report. ARK, of course, being the investment firm, probably the founder of the company, Cathie Wood, is more famous. She is well known for her highly ambitious price targets on Tesla. I believe her current target for the share price is $2,600. $2,600 a share gets you to more than $8 trillion of market capitalization based on the current share count. And that strikes me as quite ambitious. So I wanted to show this document, and I created a link to it in the description below because it's very easy for analysts to simply just throw some crazy price target on something. She has a number of analysts working for her. She's the PM, of course, for the ARK actively managed ETF. But just wanted to talk a little bit about how she got to that number and whether or not we think that's in any way realistic. Her premise is largely based on 2 things. The first is that the trend towards EVs is going to continue, and that by 2030 we're going to be dealing largely with battery-powered cars. I tend to agree with that, of course. I think that trend, although it's sort of slowed down recently, is likely to resume at some point in the future. But the bigger part of this story is not just simply EVs taking market share from internal combustion engine vehicles, but really robo-taxis. And what she's imagining is that there could be as many as 50 million of those on the road, I think, by 2030, and that half of those in turn could be Teslas. This diagram right here, which I think is kind of interesting, I'll see if I can blow this up a little bit better, reflects the cost per mile in constant 2024 dollars of a horse-drawn carriage, some pre-war car that looks like it's from the 1920s, could be a Model A or something along those lines, or something generic. Actually, that's from 1934 she has there. The 1950s, 2024, and you'll notice that at least by their work, the cost of per mile of operating a car has remained relatively constant for an extended period of time. So for 90 years, by their work, it's cost about $1.10 per mile to operate. And what they are suggesting is that robo-taxis are going to operate at closer to 25 cents per mile. The other thing that they are forecasting is that the utilization for these cars is going to be much higher than privately owned vehicles. That too does make some sense. Why would it be true? So this is sort of a track of human-driven ride hail. So you can see that the robo-taxi forecast, in this case, this forecast is for mid-2030s, at 25 cents a mile, is about an eighth of what a human-driven ride hail like an Uber costs per mile today. Now, obviously, if the cost is considerably lower than a human-driven ride hail and considerably cheaper than a personal car, it stands to reason that more people will avail themselves of it. You know, ride hailing has a benefit in the sense that it's a pay-as-you-go type of a plan, which is appealing, of course. But what's interesting, of course, too, is that, in the current environment, we've had somewhat stickier and higher interest rates. Car prices have risen. If you can get the prices down to this would actually be essentially the lowest per mile cost that people have had for car transportation in a century. So that's essentially the backstory here. And as they go through this story, eventually she gets to the point, and I encourage you to look at this yourself. I'm not going to go through the whole thing. But basically, their suggestion is that Tesla is going to have about half of the market share. And, you know, they really are comparing it to Waymo. I think Waymo is the leader at the moment in full self-driving. I think it would be safe to say they use more sensors, they have a slightly higher cost, and so that's the gist of it. Here's the problem I have. The problem I have is that at that, you know, we throw big numbers around so cavalierly these days that nobody is really giving much thought to what this would mean. So if we just take a quick, I'm going to bring up a separate tab, but let's just say, okay, so that $2,600 a share versus where we closed. Closed a little off the lows, so 227.5, so 2,600. We're assuming that the share count remains unchanged. You know, you can track things like restricted stock units. So basically, that's a more than 11-fold increase on a $731.7 billion valuation. Gets you to about $8.4 trillion. Well, the globe has about 107 trillion of GDP right now, and if we assume that that grows at, you know, call it 5%, then, you know, you're talking about, her suggestion is that the enterprise value of Tesla is going to be high single-digit percentages of global GDP. And that's a pretty extraordinary forecast. She's also expecting that the entire space is going to add approximately $34 trillion of enterprise value in total. And effectively, again, you know, then she's suggesting that Tesla will somehow own 25% of all of the enterprise value gained over the course of the next, you know, we'll call it 5 years or so. And the problem I have with this is that, you know, it's still early innings for robotaxis. So even if we assigned every positive outcome that they have assumed a high probability of success, would still be extraordinary numbers. And I would point out that there are a couple of reasons why we might doubt them. The first is that imagine when, you know, the internet was becoming a thing, when people first started using email, there were a handful of early companies that, you know, had significant market share, particularly for average folks. So for those that weren't using CompuServe or whatever, there was Prodigy, there was America Online, things like this, Earthlink. And, you know, these services have largely come and gone. And the model for how people made money in that business changed dramatically. So that's the first thing I would say. In a rapidly evolving space. Now, they have a good head start. They've achieved things that probably 10, 15 years ago most people would have said is completely implausible. That a startup EV company based in California would sell the best-selling car in the Model Y. These would probably not have been taken very seriously either. So let's agree that Elon Musk and his management team are able to accomplish things that you know, many people would otherwise dismiss. I'm just saying we're bumping into something we discussed last Friday for those who tuned in on Good Friday, which was a market holiday. I was talking with my good friend and colleague, Professor Mark Guthner of Rutgers. We were just talking about the laws of large numbers. And I think a little bit of that applies here. The other problem, though, is that Elon Musk's political involvements are really, you know, receiving quite a lot of criticism in some quarters. And it's a particularly interesting portion to alienate because, you know, living here in California as I do, you know, we have a Tesla in the driveway, our second, actually. I can say that, you know, this is, you know, the largest car market state. It's predominantly, I'm an independent, but I think most of the people in this state of California would identify as Democrats, and a lot of them are not happy about his participation in the current administration. I was driving. In fact, I wonder if I think I grabbed a picture of it. But I was driving behind a Tesla yesterday, and it had a bumper sticker on it that said, "Even my dog hates Elon Musk now," or something like that. There's a lot of that kind of thing going on. There are protesters around the Tesla stores, and I think it's serving as a deterrent, as if there weren't enough deterrents, because it seems that American consumers are sort of stretched to the breaking point. And you put all of these things together, and it's very hard for me to believe that the company is going to successfully achieve some of the forecasts that were being assigned to it even recently, and some of those forecasts weren't even that great. So as we take a look at this graph now, what we're taking a look at is a 5-year history of the share price. That's in white. So just highlight that. So that's the share price. And then we have the earnings estimates over here. And I thought actually what's perhaps a little bit more revealing was just to take a look at the actuals versus the estimates. So this is those numbers. All right. So we have the estimates in blue and the actuals in white. These are the estimates going forward. Estimates have been dropping, but in any case, you can see that even the rosiest of these going out a couple quarters, this is the one we're going to be looking at very soon, is the situation going to improve in the coming quarters over the current one? That's the first question I might ask. And then the second is, if we look at this in context, how exceptional does this look? Well, over 10 years it looks good because the company wasn't making any money back here. But over 5 years, we can see that this actually is less than the company was making back 4 years ago. So how big a multiple do we want to assign to it? I think that's a very reasonable question to ask. So, and then we can take, our next look should probably be taking a look at the volatility. Because earnings are coming up, you're going to get something that looks like this. We can see that the term structure is inverted. Near-dated options are very expensive, trading over 100 vol, as we can see here. I think one of the things that surprised me a little bit was the skew and the smile not being exhibiting more, that it wasn't more leptokurtic, meaning more fat-tailed, but actually it's just because the whole distribution is incredibly fat. I was taking a look, and what I saw was that the tails are indeed higher than they were a week ago, and they are much higher than they were a month ago. But the meat of it, basically where at the money implied volatility, has risen even more. So the vol surface is actually kind of flattened out a little bit as it's risen. That's kind of what we would expect. It's just a tremendous amount of uncertainty. One other thing I thought that was kind of interesting is that this is a stock that traditionally we see, we see volume where the options are generally pretty bullish. This is not uncommon in a lot of tech stocks, but in general, call volume will outpace put volume. You probably might find this a little bit hard to see, and I'm afraid to blow this up and then make it even harder to see. But basically, calls outpace puts and have over the last 20 days done so by an average of about 10%. Not so today. Put volume outpacing call volume by about 30% today. We have one more trading day to go, so it'll be interesting to see. I expect tomorrow's volume will probably exceed that we saw today, which was almost 1.5 million contracts. This makes it the second most active single stock option today after NVIDIA. I'm guessing it's probably going to be busier tomorrow, but you will notice that the top 4 of the top 5 options contracts were all puts. Actually, this 200 strike must have just gotten a big flurry of activity, because I was looking at this pretty quick, only with a few more minutes to go before the close, and the 225s were most active. There were some institutional block prints in there, but that's interesting. So something happened in here closer to the close. There's a 500 lot right there, electronic trade. Let's just take a look and see what kind. Okay, yeah. So that's what was going on. We had, we had a lot of activity in the last hour. These were 100 lots, so 10,000 shares apiece. Each those would represent trading electronically. That one is also a single legged piece. And let's just take a look at the total volume over the course of the last hour in these. So we'll just go from, we'll call it 1459, why not? Yeah, so 6,300 of those traded at about $3.50. That's that's a 10% out of the money put option. And that's a decent bit of premium right there. We'll just use round numbers, so we'll call it 6,000 contracts at $350 a whack. So it's $2.1 million of premium trading in these things. So I had actually written an article where my suggestion was that I think the stock's going to remain under some pressure. There's obviously a lot of bad news priced in. Just take a look at Tesla's price action today. I mean, it's down 50% or whatever from its all-time highs, but this is not great. So my thinking here was to put on some kind of a calendar, maybe a downside put spread, something along the 200 strike might not be bad. And I think I accidentally, so here we are. So we'll pull up options play really quickly. And I can just build this out. And then I'm going to go on and take some of your questions. And by the way, if you have any thoughts, comments, concerns, I'm very curious, if what your take on Tesla is wherever it is you live. I mean, Marin County, California, out, Bay Area, it's an insular world in some respects. So, just to take the political viewpoints of the community that happens to surround me, may not necessarily be representative of the respective areas where all of you all might be. So I certainly welcome hearing what your experience and thoughts are where you are. So I was sort of thinking maybe beginning with the idea that I wanted to take advantage of some of the vol crush. And actually I have the vol crush over here. This is probably going to be a little bit hard to read. So I'm going to try to blow this up a little bit so you can kind of see it. So when I talk about the vol crush, what I'm talking about is how much options premiums fall, as you go through an event. And so this is just the past 8 quarters. We can ignore the implied vol percentile. The percentile isn't really what matters. What really matters to me is what's the implied volatility ahead of the event and what is it immediately thereafter. And, in some respects, you might actually have expected it to fall a little bit more than it did. Tesla's just a high volatility name, though. It chops around quite a lot. So it wouldn't be uncommon in some names to see vol go from 55 to 30 or even below. Here we're seeing declines that are more in the neighborhood of, we'll call it 20 to, 30% or so. But again, from quite elevated levels. All right, so first things first, thinking about it from the short side. So if you're going to try to sell for the vol crush, you're trying to find a balance of not blowing through that strike and having enough time to go that there is some vega to that option to capitalize on that. Because the one thing that's important to remember, if you are short options, you like it to go to your strike. If you're long options, you want it to blow through your strike. So while it might seem attractive to choose the meatiest option one can, it probably is wiser if you're trying to play for a certain direction to, choose a strike with, maybe below a 25 delta or so. This one happens to be 21, the 185s. And I realized, look, that's probably seems like it's a long way out to the downside. But, this is a situation where, and actually this is probably a little bit further out in time than I want to go. So I guess you could probably use the 190s. Yeah, it's going to be either the 185s or 190s, looking at the May 30th, 39 days to expiration. Nice little balance there of, let's use the one, we'll stay with the 185s. And then, depending on one's thesis, you can just try to make sure that you're capturing a decent bit out in time. Maybe we'll take the September. September is typically a a pretty choppy period. And you can see that these options with 39 days to go, $7.50, those are about $18.70. So that short dated option is about 40% of the value of the longer dated one. But it covers a period of about 25-26% as much time. You know, you could do a trade like this. The other thing is that implied move I was talking about of about $24, that implied move is really the implied move going out to the end of the week. So if you're trying to figure out what the implied move is for May, or if you're just trying to find a simple way to back of the napkin it, then you would simply just, one simple way to do it would just be, okay, I'll just take the at the money straddle. And that's going to give me, looks like about $45 in round numbers. So 45, we're at 227.5. That's 182.5. So that's basically the implied move to the downside. For those who have a more bullish attitude than I possess, the upside strike that one might choose if you're looking to do a strangle swap in that case is going to be around 270, 272.5, 275. There's not going to be a 272.5 strike. So I'm going to modify this quickly so that we can just take a look at what that might look like. So we'll add 2 calls. We're going to sell one of these and see what the 270s are. Also about $8, not that surprising. And then we'll just take this over here. And that's going to go out to SEP, we'll say. And you get a structure that looks a little bit like this. But I have to tell you, I'd rather have this strategy on than a long stock right here, because I just think it's going to remain under some pressure. And this is not a knock on the company's products. I really like their products. It is not a knock on the executive team's ability to execute. I think they've done a remarkable job. I've seen the new Model Y. I haven't been in it. Ours is a year older, but I saw one at the car wash when I was getting my wife's car washed over the weekend. Looks very nice, and I think the Robotaxi does offer tremendous promise, even if you don't get, just imagine this, you don't have to get anywhere near Cathie Wood / ARC's predictions on the per mile cost and utilization rates to see that there's a lot of promise. But that $2,600 price target is very, very ambitious in my view, and arguably a little unrealistic. Okay, so that is it for that. Let me get on to some questions here. PC, for your June SPX 4,800, 4,300 put spread, when to change strikes and days to expiration? What is a good SPX hedge right now? So this is interesting. In the description to this video, you are going to find another article. That one is by Mandy Xu. Mandy Xu is a former, she may have been the chief derivative strategist at CS before. I don't remember her exact role, but she's at SIBO now. And I had that, where did I put it? Let me see. So that's this report right here. And I'm not going to walk you all the way through this thing, but I encourage you to take a look at it. It's a little wonky in the sense that it's all about vol, cross-asset volatility, correlation and dispersion. I've talked about dispersion in the past. Just as a quick reminder, all that is the degree to which the constituent stocks in an index, for example, if we're talking about the S&P 500, track together or not. If they're highly correlated or if they are highly dispersed. Trading dispersion, the general structure of that trade is to own single stock volatility and to be short index volatility. And usually in a bear market, we expect correlation to rise. And we expect index volatility to rise. And index volatility has risen. But her illustration right here, which I think is sort of the meaningful part, is that the expected stock dispersion is near 5-year highs, according to the DSPX index. She has a little bit more stuff to go along with here. But effectively, the rationale for this is that we're coming into earnings season, and you have a lot of idiosyncratic stories. That's kind of how they explain it. Some earnings have come out, many more remain. And so you're going to get that kind of a dynamic when you have all of these things happening where, stocks are basically tracking on their own stories instead of on the broad market, if we happen to be in a bear market or whatever. So what is my thinking on this? If index vol seemed really cheap relatively, and because I'm looking at it as a function not only of its time and place in history, because we think of volatility as being a mean reverting process, that is to say that if options premia or even realized volatility get up into really high areas, so 30% annualized standard deviation for the S&P is high. It's above average. 30% anticipated or implied volatility would also be above average, and our expectation is that over time that's going to revert to the mean. That said, I do think we may very well be in a bear market, and because of this, I think that for those who are interested, being hedged still makes some sense, but I would do so with put spreads to offset the fact that these premiums are somewhat elevated. I'm going to use SPY because it's easier to illustrate it here. And Michael Anthony just got home from the doctor. Why the big sell-off on the markets today? I hope you're all right, Michael. And it must have been a long appointment because the markets started lower today. Basically, I think one of the big concerns that's going on in the market right now, I'm going to construct this trade while I discuss it, is the president's, jawboning about the current chairman of the Fed, Jerome Powell. And, I'm just going to offer the following, which is that historically, we don't want politicians meddling with monetary policy. How about I leave it at that? It doesn't turn out well. It didn't turn out particularly, if you happen to think we should have had hard money, if you think we should have stayed on the gold standard, it's usually, these are political actors who change those types of things. When they change the convertibility and they try to manipulate the money supply for political reasons, it violates what money is supposed to be, which is both a mechanism to store, preserve, and exchange value. And the dollar hasn't really been a very good store of value for a long time. It's lost 99% or so of its value since the creation of the Fed in 1913. We don't want this. We don't want political actors, whatever party affiliation you have, meddling with the Fed and saying we need easier monetary policy. And I would also argue that the easy monetary policy that we've had since the GFC, since 2008, and how that has been used essentially as a panacea for any and everything that might ail us, is one of the reasons we're in the predicament that we are. And it has also helped to foster an attitude of government spending that's also unsustainable. And we do need to get these things under control. Okay, so let's just take a quick peek here. This is the trade I was just outlining. Let's say you think you want to have some kind of a hedge on. I'm looking here at a 500, 475 spread. The 475s, that's the 20 delta put that you'd be short, and the 500s are 35 delta put. One of the things I would just ask you to notice, it's a $25 wide spread. It's going to cost you less than $6 between the strikes. The payoff at the lower strike, which you aren't likely to get even if the market declines, is better than 3-to-1. Why do I say you wouldn't be likely to get it? Well, because if the market was likely going to, say, drift down to the 475 strike that you're short in the next couple of weeks, what are the chances that you would actually maintain that position without adjusting it in some way or even just monetizing it? One of the reasons you put on a hedge like this, if you think we might be in a bear market condition is so that you can monetize that hedge at a future point and maybe dollar cost average, use some of the proceeds in the event that the market declines, proceeds from your hedge to purchase more of the underlying and get your basis down. I think that's an important thing to do. I do not like hedging strategies where people simply buy puts to protect their portfolio and then just leave it in place come what may, because over the long term, markets generally track higher. So if you put these hedges on and you do not monetize them when they are profitable, that's akin to, buying car insurance but then not using it when you get into a car accident. There could be good reasons not to, but depending on how you do the financial calculus. But in this case, chances are you should probably adjust them. And that's the reason why I say, even though it pays better than 3-1 at the lower strike, the chances that you're going to ride this all the way to expiration if we see further weakness is very low. But that's, so, what does that translate to? 5,047.50 in the SPX or something like that. Okay. So Michael Cain says, wouldn't a smart person believe that the Trump administration cannot continue on this path without blowing themselves and the midterm elections up? Self-preservation is a strong incentive. Yeah, it is. It's a little different in this case. Trump isn't going to be running again, which is usually a strong motivation for president. The other thing is that they might be looking at that as a foregone conclusion and just saying, let's get as much done as we can before that time comes. I don't know whether that's a smart political strategy. It doesn't seem like a great strategy to me. I kind of feel like both parties have been on very self-destructive paths. And rather than take their position when they get it and try to build a broader coalition and gain support for the ideas that they're trying to propose, it seems like each just tries to steamroll the other, paint them as bad people, and that's it. And, there are some big problems that we need to solve, but, now we're on this sort of crazy pendulum where we're swinging back and forth, and I'm not sure that's so great. Plus, they keep having these little minor crises, that are unrelated to the things we're talking about. But, whether we're talking about signal chats by the SecDef, sharing information theoretically with people that it should not have been shared with. I don't know all of that, but it's a mess. We don't need this, and there are a lot of things we do need. And I don't know what they're thinking about the midterms. I mean, I think they're just trying to make it to the end of the year, and it's going to be. Seems like it's hard for them to do that. I don't know. Situation Room says Tesla is no longer the best-selling EV in California. Yeah, that may very well be. I don't know what is. Actually, we could probably look that up. Maybe somebody listening in can find out what is now the best-selling EV in California. But I did not know that. Where we are, they're ubiquitous, as common as Toyota Camrys, I would say, in probably a lot of parts of the country. And there's a good reason for that, because actually net of the tax incentives, that was about the cost. I mean, I can remember that a Toyota Camry, coming out of the pandemic, there was a shortage. I mean, these things were like $40,000, and they didn't have the tax incentive, and you're dealing with $5 gasoline here and that kind of stuff. So actually, other than the insurance cost, I think that something like a Model 3 or a Model Y stacked up fairly favorably, net of the tax credits and other benefits, relative to a fairly commonplace car, all of which have gotten a little too expensive, but yes. So Michael Cain, on your Tesla question, seeing minimal reaction here in northern New Jersey. Interesting. Some protesters at the dealerships, but small numbers. And New Jersey leans Democratic, but less than it used to. Yeah, very... Yeah, this is, it's an interesting thing. It's interesting, Michael Cain. I don't know if we were able to pull up live video shots or pictures. it is interesting that I saw I think it was a video, and it was in the New York area, I suspect, because I saw New York plates and New Jersey plates. It was a Tesla Cybertruck driving down a divided highway or freeway, I believe close to New York City. I think it had New Jersey plates partially obscured for privacy reasons. And somebody had put Toyota across the back of the tailgate of the Cybertruck. Not going to fool too many people because Toyota does not make stainless steel, angular space vehicles, basically, things that look like the Cybertruck. But I thought that was funny. I thought it was kind of a signal to anybody who was thinking about torching it or doing some other crazy stuff that, someone was sort of disavowing Tesla as a brand. Maybe that could have been what was going on there. It was funny in any case. And certainly, I'm sure everybody watching feels as I do that, anybody who goes and destroys private property of somebody they don't know because they don't happen to like the person that founded a company that employs tens of thousands of people, and you don't even know what their political views are. I just, anyone who does that is really sick in the head. We need fewer people like that running around, and I'm sure most of you would agree with that. That's just outrageous. But it is a reality that can affect sales because it becomes a concern. It was a concern of my wife's. I think I mentioned this on a prior live stream that, somebody that she had previously had to meet with for business reasons had quite a lot of vitriol to cast in Elon Musk's direction and would rant and rave every single time he saw a Tesla. And she didn't want him to see her in hers. So knowing that she had a meeting, rather than park close to where she was meeting with this person, she parked it, around the corner and down the block. This is a ridiculous situation. And I'm not saying that person necessarily would have attacked her or attacked her car, but he obviously had very strong feelings. But this is not something that people who buy a new car are signing up for. It's, they're expensive enough that you do not have an interest in inviting, at a minimum, criticism from people who have strong political views. But at worst, property damage or, an attack. People just don't need that. They don't buy cars so that they can face, potential threats from crazy people. And because of this, it is very hard for me to imagine that the impact on balance isn't going to be real. There's not going to be that many people who are going to race out as President Donald Trump did and say, as an effort to show support for Elon Musk, I'm going to go out and buy a new Model Y or X or whatever it was that they had that little scene in front of the White House. That's not how people operate. They're just trying to go about their lives. They don't want controversy. They're not trying to make political statements. And that would be a pretty expensive way to try to cast your vote of support for somebody, even if you did. But my point is that I expect that the skew on the political leanings of people who buy Teslas probably leans further to the left, which means you're alienating a big portion of your potential total addressable market, TAM, as we call it in the investment business. And it's not good to do that. It's not good to alienate your customers or a good portion of them. It wasn't good when Target did it. It wasn't good when Bud Light did it. And it's not good when Tesla does it. And I have a feeling it's going to show up in their earnings results. The flip side of this is that Elon Musk, I believe, if memory serves, had said he was only going to remain in Washington for something like 120 days. So it's got to be, we're running up against the deadline. And maybe, but I it's hard. It's going to be hard to pivot. Our people who loved him, bought his cars and said it's phenomenal what you're trying to do and made EVs a success. Now they hate him because he supports somebody they don't like. What would he have to do to earn them back? I don't know. He obviously has significant differences of opinion with key members of the current administration on issues such as tariffs, which affect them, and also because I think he has sort of more classical liberal leanings, which suggest that you don't want to be too isolationist. And if that's true, then you wouldn't normally be in favor of some of the more extreme policies, which are, anti-free trade. So, what was my reasoning on picking May 23rd? You usually use end of month. Yeah, it's true. I mean, I tend to use end of month options when I'm trading things myself. I was doing that because it was about 30 days. And the logic here is, so here's an important thing to think about when you're dealing with vertical spreads. Vertical spreads will go to their value. So if you look at this picture that I have up here, it will achieve that at various price points for the underlying asset as of expiration. The curved line you're looking at here, that's the instantaneous price behavior of the structure if the underlying moved today. And basically what happens is, the closer to expiration you get, the more closely that line will adhere to the expiration payoff diagram. If I were to make this go further out in time, and you'll watch this, what you're going to see is that curve is going to end up flattening out. Do you see that? I'm going further out in time. So that curve is now flatter. Not only is it slightly more expensive, but that is flatter. And actually, and this isn't all that much more. So this is $6.86. The other one was about $6. We have an equally wide spread. So you would say, oh, for just 86 cents, I can buy a trade that gives me, the same sort of strike range. But in this case, this one goes out to the end of June. So it's the first half of the year. The issue is, the trade-off that you're making is that in a fast-moving market, you're not going to get as much gamma. It's not going to track to its terminal payoff in the short term. It would have to go so far through that strike, which makes monetizing it in a downdraft a little bit more difficult. Here's a simple way to think of it. In an ideal world, if you knew the market was going to drop to 475 for SPY tomorrow, you would love to have the 500 475 put spread that expired tomorrow. That one will go from cheaper to its full value by the end of the day tomorrow. So the trade-off that you're making by pushing expirations further out or bringing them further in is that if you buy further out, you're taking on more long vega in a high vol environment, and you're getting less gamma, less convexity. So that would be the reason in a high vol environment, maybe you pull it in just a little bit. I hope that helps. Now, if you just bought an outright, not as much of an issue. You're still going to have less gamma because higher volatility options, the highest gamma you can achieve, short dated option, low vol, close to expiration, close to the strike. So if you start tinkering with any one of those sort of highest gamma environments, it's always going to be making it lower and lower. So going further out in time, turning it into a spread, higher implied volatility, further away from the money, all of those things are taking away that convexity. And convexity is kind of what you're looking for in a really choppy market so that you can monetize it. So I hope that helps a little. Okay, so I apologize for keeping this one shorter than I usually do. I will be back on Wednesday. I think Brian Stutland's going to be joining us. Last Wednesday there were some issues with Zoom. It was down globally at the time that we did our live stream, and that's the way he dials into these. And so that was going to be very difficult. But I have to make a jump over to Fast Money on CNBC. I really appreciate all of you tuning in today, even though it was a little bit shorter. Like, subscribe, notification bell, add your comments. If you have some suggestions for topics that you would like us to address if Brian is able to join us on Wednesday, put them into the comment section for this video. And that way I can give those to him ahead of time and he can give some thought and maybe even prepare some slides, which can be very helpful. And it would be good to have him because he is a volatility trader. He's a former VIX options market maker. It's kind of his area. And he runs a long equity book for his clients. So, he has sort of the two perspectives I think that matter most in an environment like this one. So until then, thanks for watching.